Hello and a very warm welcome to the Trobe Financial July Investor Update Call. I'm Bridget Crowe, Head of Corporate Affairs at Trobe Financial. Thank you for joining us today. During this presentation, your lines will be in listen-only mode. I'd also like to remind you that the webinar will be recorded. Some people have submitted questions ahead of time and we'll try to address these questions throughout the presentation in the relevant places. If time permits, we'll also take questions at the end of the presentation. To submit your questions during the presentation, please click on the Q&A button at the bottom of your screen at any time. Please note that we won't be able to speak to individual account questions in this forum, but our investor team is always available to take your calls and questions on 1800 818 818. I'll now hand over to our Chief Investment Officer, Chris Andrews.
Thanks, Bridget, and hello to all joining our July Investor Update. Last month, we pointed to the first green shoots emerging in our economy, really sooner than expected. But we did note that challenges would remain and that the path to recovery would not be a straight line. We said that setback clusters of infections were to be expected. And that's exactly what we see this month. So we have parts of Victoria, including Melbourne, re-entering stage 3 restrictions on the back of a spike in infection levels. So for now, it's the tale of two Australias. But the big picture trend is that our national economy is continuing to progress back towards normality. Now, there will continue to be setbacks. There will continue to be bumps in the road along the way. But the economy is substantially better positioned than it was just a few short months ago in March and in April. The team at Trobe Financial is on station and will continue to support all of our customers just as we've done since 1952. The hibernation phase and the emerging rebound phase have not and they will not change our commitment to ongoing service really for all of our customers, both borrowers and investors. Now, we've had really great feedback on last month's update, and in particular, the presentation from our Chief Financial Officer, Martin Barry. So today, I'm really pleased to announce that we'll hear from another of our senior leadership team, our Chief Lending Officer, Corey Bannister. We will, as always, finish up no later than 12 noon Australian Eastern Standard Time. So let's begin, as we always do, with a quick update on Trobe Financial and our business. And there are 7 key points that every client of our business needs to know. First, our investment assets are sourced from the $1.8 trillion Australian residential mortgage market and the $650 billion commercial mortgage market. That's an exceptionally broad and deep total addressable market, far larger than the stock market, for instance, which is a terrific opportunity for portfolio construction. Second, we have 11 billion in assets under management. We're continuing to grow, which is an indication of the consistent interest from investors, both retail and institutional, in our offerings. Third, we deploy 404 staff across 4 offices, so Melbourne, Sydney, Hong Kong, and Shanghai. Fourth, we have close to 7 decades of experience covering some 150,000 clients, so a really significant contribution to the growth of the Australian economy. Fifth, our annual asset origination flow is around $10.3 billion worth of investment grade assets. And from that, we select just $5.5 billion to invest in. This is proof positive of the investment disciplines that we maintain throughout our portfolio construction process. Sixth, we have highly diversified funding and capital sources, the most diversified in the sector. These can be considered under 3 broad categories. We manage $3.6 billion under institutional mandates. So these are from 3 of the big 4 banks, 2 regional banks and 3 household name global banks. All of these have been excellent long-term supporters of the business, in some cases for many decades. Our retail credit fund holds around $5 billion in assets under management and continues to grow month on month. Now, we manage these funds for over 45,000 investors who range from sophisticated fund managers, family offices, finance houses, right through to everyday investors. We also manage for global institutional investors a capital markets program. So this currently has $4.4 billion outstanding in residential mortgage-backed securities, or RMBS. Our Chief Financial Officer, Martin Barry, spoke about these investors and this strategy, this funding strategy, in last month's investor briefing. Finally, we're a portfolio company of the US-based Blackstone Group, who have over $538 billion of assets under management globally. So at a corporate level, we're very well placed. Our balance sheet and our profitability are both strong. We've built a really deep reservoir of trust with our investors, and the leadership team are co-investors in the credit fund with some $123 million invested. As to our people, we have a very deep bench of industry professionals, and that's, of course, as you would expect for an organisation of our size. I've identified some of our recent senior appointments previously. Gary Bell, former head of liquidity risk at the National Australia Bank, including through the global financial crisis. Gary's our chief liquidity officer. Our deputy chief lending officer is David Blakely, former chief risk officer of the ANZ in North America. Our head of corporate affairs, Bridget Crow, has well over 20 years Wall Street experience in firms such as JP Morgan and Goldman Sachs JB Weir. Rick Drury, the former head of the National Australia Bank's workout and turnaround area, and also their UK commercial property operation. Rick heads up our asset management risk team. Deputy Chief Investment Officer Troy Stratton has over 2 decades of experience in wealth and financial services at names like Barclays Bank and HSBC. Our head of platforms and investment operations, Annie Sestito, is formerly of Westpac St George and ME Bank. She's a seasoned and experienced funds management executive and banker. And we're committing to continue to build on this team as our business grows. In a moment, you'll hear from another of our 5 senior vice presidents, Corey Bannister. Corey is our chief lending officer and will today do a deep dive into our asset selection and approval process, a really fundamental part of our business. Corey's been with us for more than 2 decades, so really there's no one better placed to speak to the rigour, the focus, and the approach that we bring to credit approvals at La Trobe Financial. Our business is built on an unwavering commitment to the highest standards of disciplined investment execution. So we've previously discussed the consistent and measurable improvement in asset quality as we've continued to grow our business. So this, of course, has been the result of active management by our portfolio managers. It's also been supported and accelerated somewhat by the contraction of the credit appetite of the banks in the wake of a variety of regulatory changes, including the Royal Commission, which we heard so much about over the last 12, 18, 24 months. The chart on screen shows our portfolios in June 2016. Prime and super prime assets were 28.2% of the portfolio. Here we are 4 years later, that has grown to 37%. So that's up 31% over a 4-year period. Similarly, the higher returning but somewhat riskier specialist assets were 19.1% in 2016. They're now 9%, a 50% reduction. We're expecting this measurable thematic of de-risking in our portfolios to continue in the forward period. Obviously, that's of significant benefit to all of investors across all of our funding lines. Our current lending program is reflective of that. And of course, as you'd expect, we're taking particular care to ensure that high quality assets are originated and settled in the current environment. So that's the corporate side. Let's now turn to the monthly investor portfolio update. And to start with, as I said at the beginning, I'd like to welcome our Chief Lending Officer, Corey Bannister, to take us through La Trobe Financial's asset selection process and speak really to how that's been influenced by current events. Hello, Corey, can you hear me?
Hello, Chris, and hello, everyone. As Chief Lending Officer, I lead La Trobe Financial's Real Estate Credit Division and have responsibility for originating and approving the assets that we use to build your investment portfolios. Today, I'd like to provide you with a look into the fundamentals of our credit process and how COVID-19 is impacting credit assessment. The Real Estate Credit Division has over 150 finance professionals led by a very experienced executive team with an average of 24 years of experience each, giving us a very rich and diverse knowledge base over multiple cycles to draw upon. I'm assisted by a Deputy Chief Lending Officer, David Blakely. As the former Chief Risk Officer for ANZ Bank in North America, David has a tremendous background in risk management and investment discipline and deploys that expertise to ensure we maintain the same high quality in our asset selection disciplines as we've done in the past. Let's now take a look at the fundamentals of our credit research, being the 5 C's of credit. The 5 C's of credit is an industry standard analytical framework used to assess credit applications. We undertake this comprehensive analysis on every loan we consider, irrespective of the funding source, which of course means that assets placed into the credit fund are subject to the same rigour as those placed in institutional investor mandates or those portfolios issued to global investors through debt capital markets, as you heard about in our June update from our Chief Financial Officer, Martin Barry. The first of the 5 C's is character. Located in the top left-hand corner of the slide, character is the big picture review of applicants and considers their personal details, background and situation. One key component is their stability, both in terms of residence and employment, where we give consideration as to whether they're moving house every year or moving employers regularly. Another key test is a review of the applicant's credit history. There's a strong correlation between past credit impairment and the likelihood of future credit impairment. So we access the individual's credit report from independent credit reporting agency Equifax, and we also request copies of the applicant's existing loan statements to check their repayment history, looking for missed, dishonoured or irregular repayments, as well as repayments being made via other credit facilities, effectively repaying credit with credit. All of these can be really strong warning signs to our credit team. Whilst we're on the topic of credit history, I'll talk briefly now to the quality of our borrowers. On this page, we see information from the independent credit bureau Equifax, which provides credit reports for all Australians. The data on screen from Equifax summarises the credit scores of La Trobe Financial borrower applicants against those of our peers. Objectively, our borrowers are a very high quality cohort. You can see from the column graph on the bottom left-hand side where the borrower distribution by score is right and tight in the very good to excellent ranges. That dynamic is very supportive of resilient portfolio performance. Further, the credit quality of our applicants is visibly improving over time. Witness the rise in the red line on the top left-hand side graph. This is, of course, external confirmation of our earlier observations about the ongoing improvement in borrower credit quality in our portfolios, which you can see is above the peer average. That's perhaps not so surprising given our reputation for conservatism in our lending program. Finally, thinking about the potential impact of the coronavirus, it is likely to generate a range of issues for borrowers who have been or are still affected by the hibernation phase. Our team have excellent experience in dealing with credit events such as this and look to identify the can't pays from the won't pays, the latter simply not the applicants that we're looking to lend to. Coming back to the 5 C's now. The second of the 5 C's is capacity, located in the top right-hand corner of the slide. Capacity is the quantitative assessment to determine whether the applicant can pay based on their available income after all household living expenses and other liabilities are repaid. This is a very regulated part of our assessment process. Like the banks and other lenders, we are bound by the responsible lending obligations of the National Consumer Credit Protection Act. So we need to determine that applicants can meet their commitments without substantial hardship before we can approve a loan. We obtain multiple sources of income evidence, such as payslips and tax returns. We then independently verify the evidence provided, which for PAYG applicants will involve a phone call to the employer to verify those details. For self-employed applicants, we seek verification from a qualified accountant, focusing on the income declared and whether the accountant is aware of any factors likely to have a materially negative impact on future earnings. This verification process with employers and accountants directly is extremely important throughout this period of lockdowns and business interruption, where a view of historical earnings is a much less reliable indicator of future income. Finally, where an applicant receives rental income, we obtain a copy of the lease, or if the property is not yet leased, we seek an independent appraisal by a valuer or via multiple real estate agents. And regardless of whether the property is leased, we reduce the income by 20% to allow for future periods of payment disruption. So that covers off the money inside of the equation. The next step is to verify the money out or expenses side. To do this, we look at 13 separate expense categories and compare that to an industry benchmark. the household expenditure measure, or HEM, to ascertain the reasonableness of those declared expenses. Where the declared expenses are below or close to the benchmark, we may ask for personal bank account statements to reconstruct their expense position and take the higher of the two tests. Finally, we deduct any existing liabilities, including a percentage of available credit card limits, along with the proposed loan commitment, with a 2% per annum interest rate buffer added to stress test the applicant's ability to withstand any future interest rate increases. Only when a surplus of borrower income is evident will we consider approving a loan. Moving clockwise now to the third of the 5 Cs, being collateral. This is the property asset that secures the borrower's obligations. We target granular exposures of non-specialised properties. We obtain an independent analysis of the property from a fully qualified third-party valuer and set our loan amount based on an appropriate maximum percentage of the property's value to mitigate against any future loss. For assets in the credit fund, this maximum percentage of the property's value cannot exceed 75%, meaning a property's value would need to decline by 25% prior to capital being put at risk. Our average loan to valuation ratio is only 63%. That's a substantial margin for safety that is real protection for investor capital. So whilst we're on the topic of collateral, let's look briefly now at the property market. First, national house prices were down in June by 0.7% on top of the 0.4% reduction in May. Melbourne continues to see the highest level of price reduction, and this is likely to continue as the case for the next month or two at least, given the coronavirus setback. When you deep dive into the reductions, particularly in the large capitals, it's the higher value properties seeing the largest falls, and that's a very typical phenomenon with house prices in Australia. Nationally, however, activity levels are up dramatically and well ahead of expectations. Sales activity increased by 29.5% after an increase of 21.5% in May. New listings are approaching 2019 levels, as are clearance rates that are now around decadal averages. That's a pretty solid base given the macro picture. We're expecting continued softness in the third quarter. Melbourne is likely to be a drag on outcomes. However, overall, our early prediction of a circa 8 to 12% correction still appears to be appropriate. And to us, that represents the normal functioning of a healthy market against a volatile macro backdrop, mid-air turbulence, if you like, rather than what some of the more febrile headlines would suggest. And we emphasise, as we have previously, in the 12 months leading up to the coronavirus, Sydney and Melbourne were both up 10 to 15%. So the vast majority of homeowners have very substantial value buffers, which will protect them against material negative equity issues. On page 12, we can see how new listings have rebounded and are turning to the levels seen in 2019, which were themselves low. And combined capital clearance rates are now very much in line with decadal averages. However, the next month or so is likely to display some softness here, since Melbourne is the auction capital of the nation and public auctions are disrupted for the next 6 weeks. And that's a sort of dynamic that's driven the resilience of housing markets in prior correction events, which you can see on screen here. We do keep returning to this chart because it's a great way to keep an objective eye on previous correction events, rather than relying on the media's propensity to run with the most sensational predictions of our commentary at. Coming back now to round out the 5 Cs deep dive. The 4th C is capital. In the credit fund, borrowers need to contribute a minimum 25% deposit to obtain their loan. Not only does this give us a significant margin for safety, but it also ensures the borrower has a lot of skin in the game, which is a very powerful motivator to ensure they meet their repayment obligations. The 5th and final of the 5 Cs is conditions, which we apply to the approval of the loan. Specific approval conditions are applied at an individual loan level based on the loan-specific risk circumstances we identify through our assessment process to ensure we obtain appropriate evidence of the information supplied and or to provide additional security to mitigate such risk prior to advancing funds. The end result of this disciplined investment process can be seen in the next slide here. The asset quality dashboard is a selection of key metrics from our monthly portfolio report that go to the quality of the assets in your portfolio. You can see our portfolio average loan to value ratios around 63%, We take a conservative view on loan to value ratios because we understand that property values will go up and down from time to time. However, they are less volatile than equities markets. Nonetheless, we want a significant margin for safety in our portfolios. Your Chief Investment Officer and portfolio managers like small investments, as you can see from the average investment size on screen, just $540,000 in a $3 billion 12-month term account portfolio. Small investments are much more robust to market disruption than city office towers, for example, and perhaps even more so in the current environment. We require quality borrowers as the key credit metrics in the table show, and quality metropolitan locations as a significant portfolio tilt. I hope that gives you some insight into the robust and rigorous process we undertake on each and every loan we assess and approve here at La Trobe Financial. The sole purpose of this very extensive process is to ensure that we maintain the highest quality of asset in the industry and so produce a resilient and sustainable performance profile for all of our investors. Thank you for your time today. Back to you, Chris.
And thank you, Corey. The diligence, the attention to detail that our real estate credit division display, of course, that's a key driver of portfolio performance. So insights from Corey and his team are always very welcome for our investors. Turning back now to our portfolios, our 30 June portfolio report is on our website and freely available to all. We do encourage all of our investors to review this report regularly. It gives an incredibly detailed overview of the portfolio, but also how our portfolio managers have positioned the various individual portfolios to flourish through this period of market volatility. Now, this month, we've added an additional disclosure in relation to borrowers under hardship arrangements. We'll talk more about this in a few moments, but that is borrower hardship arrangements on an account-by-account basis. We note that effective 1 July, we've adjusted interest rates, distribution rates in the credit fund to reflect lower market interest rate conditions. Our classic account is now returning 1.3% per annum. Our 90-day account is returning 2.5%. Our 12-month term account is returning 4.5%. And our 4-year account is returning 5.65% per annum. Having said that, the income profile of the credit fund remains very strong. The performance of $100,000 invested in October 2002 obviously depends on the asset class in which it was invested. So the different coloured lines you can see on screen reflect the performance of different asset classes. Dark blue is cash, green is property securities, light blue is bonds, red is global shares, and grey is Australian shares. Take a look at the thick orange line. So that's the 12-month term account, which started in October 2002. For a defensive exposure, its performance track record, even in absolute terms, over that period is incredible. Its performance is also incredibly consistent, or as we say, low in volatility. It simply keeps on performing month in and month out. And that's why it presents that gently curving upward shape rather than the ups and downs of other asset classes. Now, obviously that's important for investors because it takes the question of timing of an investment off the table. If you invested in shares in 2007, for example, you immediately incurred substantial losses as the global financial crisis played out. In fact, even today, you're still down about 12%. That's 13 years later. By contrast, our classic account, our 90-day, 12-month, 4-year accounts, they continue their flawless track record. None of those accounts has ever lost a cent of investor capital or missed a monthly distribution. What's more, none of them has ever failed to pay an investor redemption in full at maturity. Now, that's the performance profile we are trying to deliver for investors. In previous months, we discussed our strategy to hold overweight cash positions in the fund during this period of market volatility. Consistent with our recent guidance, you can see that we've commenced a measured reinvestment program, but we are still sitting with cash holdings in our classic account of greater than 50%. Now, we're going to continue our watching brief on this issue. Our preference is to tilt back towards reinvestment, but to do so in a very steady and measured way. Our commitment to diversification as the one free lunch in investment, as we've often said, that commitment remains intact. So you can see the incredible diversification we drive into these portfolios. And that, of course, as Corey pointed out, is an important risk mitigant. And when we think about diversification, we think about it by number of loans, by average investment size, by largest investment, by sector, and also by geography. Zenith Investment Partners has previously described the 12-month term account as the most diversified portfolio in the sector. Frankly, that's what we're aiming to deliver. So we're really pleased to hear those sorts of observations. Our processes and portfolios are subject to independent review by Australia's leading independent ratings agencies. Independent validation of portfolio decisions and holdings is important for investors. Our approach to portfolio construction and our rigour around the selection of assets has resulted in Australia's leading ratings agencies awarding the highest ratings in the sector to our offerings. You can see all key ratings on screen. All are available on our website. A key issue for our economy is the temporary hardship relief lenders across Australia have provided to borrowers whose incomes have been affected by the coronavirus hibernation phase. Now, our experience with hardship borrowers at La Trobe Financial has been really pleasing. Hardship levels peaked in mid-May, and there are very few new hardship claims being made. At a group level, and as at 10 July, hardship levels are down 27.6 from their peak. And that's, of course, as borrowers return to normal repayment arrangements. In many cases, they're doing so ahead of schedule. Of these, around 15% or 15 percentage points were voluntarily withdrawn by borrowers ahead of completion of their hardship arrangement. So that's a very strong indicator of the resilience of our borrower cohort when they voluntarily return to repayments. Meanwhile, our hardship team is conducting a comprehensive borrower assistance program. That program's confirming that the vast majority of remaining hardship borrowers are expecting to return to repayments at the end of their hardship arrangement. We're currently projecting something like a 2 to 3 percentage point transition to work out at the end of the hardship arrangement. Now, obviously, we're going to manage that very carefully. We'll handle it sensitively. Our collections team are always very sensitive to the issues that borrowers are facing. But as always, the emphasis will be on protection of investor capital. All in all, we're seeing really positive objective indicators for hardship borrower performance. We'll obviously be working very closely on a borrower by borrower basis to ensure that this trend continues throughout the economic ups and downs, if you like, of forward months. Turning to hardship loans in the credit fund, we'll use the flagship 12-month term account as our measure here, although the performance across all of our accounts is following a very similar trend. You can see really quite dramatic improvement in hardship levels in our portfolios throughout the month of June. We were projecting at our last investor call material recovery in these numbers, but the speed of the borrower rebound, I've got to say, it has surprised us on the upside, which is really pleasing. From a peak of 13.5% of assets under management, hardship loans dropped to 12.8% at the end of May, as we reported last month. By the end of June, that number had dropped to just 8.8%. So that's a 38% improvement in 1 month, which is obviously very pleasing. Our low loan to value ratio positions, it really put us in a really great place to deal with any borrowers who do struggle to return to repayments at the end of the hardship arrangement. So on screen, you can see the original LVR position and the LVR position based on updated valuations and 4 months of capitalised interest. Now, this actually overstates likely actual LVRs because it doesn't take into account borrower heads, early hardship completions and the like. However, as you can see, even after hardship, there is a very material margin for safety in our portfolios. And that's the point of our conservative low LVR program. And you can see that compared against the reported outcomes in the Westpac group in that final column on screen. Our experience is, broadly speaking, being reflected in the market. Most lenders are reporting material improvements in hardship levels. It is the case that timely reporting is still a bit hard to come by, so reported trends do tend to be quite out of date. Nevertheless, there are consistent themes as to the sectors of the economy where borrowers are most affected. Accommodation, food services, bricks and mortar retail, and so on. No surprises about any of those components. In our portfolios, hardship loans are broadly consistent with our overall exposures, whether we think by sector, by geography, and so on. So we make the final observations about hardship in summary. First, hardship levels are dropping rapidly and well ahead of expectations. Secondly, our portfolios are really well positioned with strong LVR buffers as an important protection for you, our investors. Thirdly, we project that something like 2 to 3 percentage points of these borrowers will transition to workout. Our collections team will be working very closely with them to ensure optimal resolutions for them as borrowers, but also, and most importantly, for you, our investors. So based on all of the above, we're not experiencing, and we're not expecting to experience, I have to say, any undue portfolio stress from these hardship loans. Pleasingly, the credit fund has recommenced its growth trajectory on the back of continued strong interest from investors. So in June, assets under management were up by about 40 million. Just as pleasingly though, for us as a manager, this growth has been concentrated in our longer dated accounts. So this continues to improve the credit fund's average investment tenor, and it is supportive to our group liquidity profile. So that's the monthly portfolio report. We're really seeing the resilience of the fund portfolio in action at the moment. But there are some big questions to address. So we now turn to the economic outlook and the bumpy road to recovery. And this month, there are two key issues to consider. Firstly, it continues to be clear, as I've already said, that the economic impacts of the coronavirus have not been as severe as feared in early April. The economic rebound has come much more quickly than expected, at least at the moment for the 74% of the economy that is non-Victorian. On the other hand, the spike in infections in Victoria has put part of that state back into stage 3 lockdowns. So given that Victoria is about 26% of the national economy, a 6-week lockdown equates to something like a 0.2% headwind to national GDP per annum. In our view, economies and businesses have to be preparing for further bumps in the road, just like this one in Victoria at the moment. The road to recovery from a pandemic as complex as this will never be a straight line. What we need to do as an economy, as a society, is ensure that we continue to learn from these incidents and get better at managing them into the future. We remain of the view that our economy is transitioning from the hibernation phase to the rebound stage. And I know you've heard a lot from us on this topic over the last few months. The length of this transitional period will depend on the success of our governments in speedily addressing the Victorian outbreak and any other outbreak that occurs. Different geographies within Australia will experience the transition at different times. With 3/4 of the Australian economy moving into the rebound phase at the moment, we are seeing increased economic activity. And certainly as a group, we're observing a pickup in inquiries from customers across our business. Now, our expectation is, as we have said many times, economic growth will recover rapidly as the year progresses, but it will not get back to pre-coronavirus heights. This is going to be reflected in higher unemployment levels that take some time to work through. Investors need to get their heads around this to avoid any unpleasant shocks in the months ahead. I stress we will face challenges. Critically, we expect that, and this is even putting aside or ignoring the possibility or prospect of vaccines or treatment developments, our governments and societies are not passive actors here. They will become progressively better at managing the coronavirus risk. And this, of course, is going to be a substantial benefit to our societies and to our economies. The longer term picture sees global economic realignment. So expect a focus on insourcing of key industries and diversification of external supply chains. Economic nationalism will increase, and we might see a secular decline in world trade. And this will of course reverse the offshoring trend of the 1990s, as we've previously observed, at least to some extent. At La Trobe Financial, we anticipate that structurally low interest rates and a conservative banking system, it will mean that there will be increased demand for our offerings. We expect to invest substantially to ensure that we've got the capacity to maintain our service standards for our borrowers and also for our investors throughout. On screen now, you can see projections from most of Australia's key institutions and economists, and we make two very simple points here. First, the reality behind the sensationalist headlines. Look, if you watch the media every day, you will see the sensationalist headlines of that moment. The reality behind this is that the overall outlook continues to improve. In all published cases, recent economic projections are materially improved on those of a few months ago and really substantially improved. The expected hit to GDP in 2020, the projected peak unemployment levels, all of them have been reduced and in many cases reduced quite significantly. And that is unambiguously a good thing. But it does not mean, and I stress this again, it doesn't mean that there won't be setbacks. It does mean that we're getting a better handle on the challenges that lie ahead. And as I said, that is a good thing. The second point is that the consensus view about the impact of the Victorian setback does come in at around 0.2% of annual national GDP plus or minus. And that's assuming a full 6-week lockdown as has currently been discussed. So yes, this setback is frustrating, certainly grant that. It's damaging to many businesses, absolutely. But we do have the depth and we do have the fundamentals in Victoria, but also in Australia more broadly, to manage this and other setbacks into the medium term. Our headwinds and tailwinds are broadly in line with our talking points of last month. The most obvious headwind is the ongoing battle against the coronavirus. So right now, in particular, the Victorian setback. Obviously, the quicker that's resolved, the lower the eventual long-term economic impact. But the battle will continue for some months to come, make no mistake about that. High-frequency Australian Bureau of Statistics data continues to show the most pronounced effect of the hibernation phase is on sectors that have had to close entirely. Obviously, think hotels, think restaurants, think museums, think gyms. Our thoughts are with all of those affected in those particular sectors. Now, as a manager, we don't have big exposures to those sectors in our portfolios. And I should say, apropos of some questions that have been put prior to this presentation, we also, our exposures are all in Australia. So we don't have any exposures to the more troubled jurisdictions overseas. But sectors like accommodation and food services, for example, it's just 3% of the fund. Arts and recreation services is just 1%. So our exposures to those peak impact areas is very small, but the macro impact is well worth watching. What we want to be as a society particularly careful about is that these industries are typically dominated by young people. So we want to ensure that the temporary hibernation phase doesn't become an extended period of unemployment for our secondary and tertiary levers, for example. The Australian economy will be adversely affected by the temporary halt to net overseas migration, and that of course has accounted for 57.5% of our population growth this century. Our expectation remains that economic and budgetary imperatives will ensure that this is resumed as quickly as possible. In that light, the recent announcement of loosening of migration restrictions in relation to people from Hong Kong is perhaps the first of many such steps. However, the temporary absence of migration will be particularly problematic for our education and tourism sectors. OECD data is also clear that global trade, when measured by shipping and cargo volumes, has dropped dramatically since the onset of the coronavirus. This comes on top of a variety of political and geopolitical trends against global trade. Now, obviously, the risk is that economies turn inwards, and that is, of course, what they did during the Great Depression in the 1920s and early 1930s, and the results will be predictable and negative. So we're continuing to support measures to ensure that the playing field is level and fair. Make no mistake about that. Let's all ensure that the vulnerable are protected, but let's not regress into warring tribes on the global trade playing field. We turn now to our tailwinds, and we remain of the view that the governmental and regulatory support for the economy throughout this hibernation phase here in Australia, it's been critical and will continue to be so. It's a substantial tailwind that the federal government has been recently announcing intentions to provide targeted support to key affected sectors of the economy beyond the current JobKeeper program. There's also talk that tax cuts slated for the next few years could be brought forward as a permanent stimulus measure. Now, all of this will be welcome. All of this is a distinct tailwind for the economy. More details have been promised at the Treasurer's Economic and Fiscal Outlook on the 23rd of July, so do watch this space. We've previously discussed the surprisingly quick return to more normal spending levels from the trough in early April. There are any number of indicators here. The data that we could point to comes from all sorts of sources, but the rebound in retail trade to higher than pre-coronavirus trend levels is remarkable, and you can see that on the right-hand side on screen. This is a pointer to a rebound that's occurred much faster than expected by virtually all forecasters. And I have to say, we'll put our hands up here, that includes us here at La Trobe Financial. The reopening of 3/4 of Australia's economy is a clear tailwind. Even excluding Victoria, this represents a substantial return to normality for broad sections of the Australian economy. Businesses and workers across Australia are getting back to work, and this is driving up economic activity across entire sectors of the economy. Further, our broad, our flexible, our diverse economy, we are well positioned as any to deal with this type of challenge, the challenge that we're facing now in the global pandemic. In late June, the IMF downgraded its economic outlook for the entire world on the back of coronavirus-related pressures. The sole exception to this downgrade was here in Australia, where the IMF actually improved their outlook. So that is solid testimony to the resilience of the Australian economy. So let me repeat, and I'll repeat word for word what we said last month, because we believe our base case is still very much intact. And our base case is, as we move into the rebound, is that we will recover some of the economic damage of the hibernation period, but not all, and certainly not all immediately. The most encouraging sign we're seeing right now is the high degree of cross-governmental alignment and cooperation. There will be challenges in the months ahead. The Victorian setback is the first, and it's likely that there will be others. But the fundamentals of Australia's economy are intact and are strong. With consistent leadership, we're as well positioned as any nation in the world to meet the challenge of the global pandemic and to thrive. So let's conclude now by reviewing some of the more topical issues in the sector and how they will impact La Trobe Financial. And the first issue that we'll take a look at is corporate financials. We expect continued profitability throughout the coronavirus period. We have a very strong balance sheet. We've got a really strong net asset position, really strong fundamentals in our business. We're not expecting to do any, or take any rush, if you like, to capital raising. We're well positioned to meet any issues arising in the current environment. We've built our business really as we build our portfolios, and that's that we want to be resilient to market volatility and to the ups and downs of the economic cycle. Our liquidity fundamentals remain strong. Assets under management are growing month on month. Our short-dated accounts remain substantially overweight cash. Tactically, we're shifting to a reinvestment bias, and we're doing that in line with prior guidance to investors, but we will continue to monitor market developments very closely. We reserve the right to adapt this approach as conditions evolve. Specifically, should there be a need to increase cash holdings at any point, we continue to be really well positioned to do so. Our commitment is to retain a contingent liquidity plan that provides us with plenty of flexibility and the ability to manage a range of market liquidity conditions. Our track record is that we've always paid redemptions in full at maturity, and we see nothing that will change that track record. Our portfolios, from the perspective of official cash rates and interest rates, our portfolios have been resilient to cash rate decreases over time. Investors have been substantially shielded from these over extended periods, reflective of our ability to obtain good premium from our borrower customers. The most recent monthly adjustments are broadly reflective of what's happening in interest rate markets. The Reserve Bank is now operating its official cash rate at what it's previously described as its effective zero bound, that is, its lowest interest rate setting. So we're not expecting any official cash rate cuts into the medium term. Our modelling continues to indicate that current interest rate settings are broadly sustainable, given the medium-term portfolio income profile that we're seeing in the fund. But we will, of course, continue to review this monthly, as we always do. We'll take into account any evolution in market interest rate profiles. The treatment of borrowers in hardship, just to tie up that issue, it's a standardised industry-wide approach, of course, that we're applying here at La Trobe Financial, and it applies to natural disasters, to temporary personal circumstances affecting borrowers, and so on. In line with our portfolio report earlier, we're seeing a really clear and a very mature trend of improvement in borrower hardship levels. These are occurring well ahead of expectations, which has been very pleasing. Certainly they're occurring well inside the stress test scenarios that our portfolios were running just a few months ago and that we discussed in these updates. The major banks and APRA have recently announced a phase 2 support package for borrowers who require further temporary hardship assistance. This will be more targeted than the initial hardship package. It helps ensure a managed return to normal repayment terms for key borrower cohorts. Our hardship and collections team will be working very closely with our borrowers on a one-to-one basis to establish a clear path to return to normal repayment arrangements. Now that's already occurred, as I've said, with more than 27% of our hardship borrowers. Most impressive outcomes from our hardship team there. Congratulations to them. Indications from our assistance program is that 2 to 3 percentage points of borrowers will transition to workout arrangements. Now, it could be slightly higher, could be slightly lower, depending on a number of variables. We'll obviously be working very sensitively and carefully with these borrowers, but we will prioritise return of capital at all times. Now, what is frequently not appreciated is that hardship arrangements are themselves subject to a responsible lending overlay. They're a bridge through difficult times, not a debt forgiveness program. Arrears levels remain broadly consistent with historical experience across all our portfolios. I have to say we're anticipating somewhat elevated levels in the more aged arrears brackets over the next few months, and that's of course because there will be a delay taking enforcement action and taking some mortgagee in possession properties to sale, given the slowdown in the property market. We'll obviously be watching those numbers carefully, but we are not seeing and we're not expecting to see any undue hardship in our portfolios there. Our collections team are of course really well versed at working with borrowers in difficulty and also working through periods of market stress. I say again, we'll be compassionate to borrowers in difficult circumstances. We will have regard to the unprecedented economic shock caused by the coronavirus, but ultimately our focus will remain properly on calling up loans where borrowers' circumstances have changed and they're unable to meet their loan obligations. And we're making no apologies for that. Turning finally to the sector overall, and we're seeing really strong fundamentals across the system. Aggregate housing finance levels in May were near record levels actually, although this was mostly on the back of a surge in refinance activity as some borrowers chased lower rates. There was some pickup in first home buyer activity in May, but investor lending continues to turn down. And that's been a consistent theme in the market for the last year or two. Securitisation markets have been very active for banks and non-banks alike. The strong support for Australian mortgages continues to be a thematic for global and domestic institutional investors. So that's the safe harbour thesis surrounding these assets, and that very much remains intact. Last month, we spoke about the Structured Finance Support Fund overseen by the Australian Office of Financial Management. So the AOFM has placed just $3 billion of a proposed $15 billion fund. Once again, we're seeing the benefits of decisive early intervention, a strong signal of intent and a strong signal of capability to execute on an assistance package. In many cases, that's enough to ensure that the requirements, the actual requirements, are much less than expected. So that's an observation that applies as much to portfolio management, I have to say, as it does to regulatory intervention, but the outcomes there have been really strong. Negotiations around the AOFM's forbearance facility are nearing completion. We're expecting launch either this month or in early August. And that, of course, will be a 5-year cash flow support for warehouse and RMBS structures. We'll be making a determination in this period as to our involvement in the program. Obviously, it's extremely helpful. We've received some excellent feedback on it from global investors. As always, though, it's going to need to hit our strategic and economic hurdles for us to proceed. The initial period of, if you like, credit market volatility, that's subsided. So markets are going to remain cautious for some time, certainly the next 6 to 12 months at a minimum, but they're certainly more settled, and that's reflecting in spreads and volumes, trading volumes across markets. Our banks are well capitalised and regulated. It does seem that the lessons of the global financial crisis. So that's higher capital levels, swift and coordinated regulatory interventions, all of those things. They've all been learnt, they've been implemented well across our systems. Broadly, experiences in relation to hardship loans appear to be generally consistent across the industry and generally well managed. So on that note, we turn now to questions. We have a few questions. I see a few from Jason. Look, some I can see we've already addressed. So regarding ratings report, we've just had an update from Zenith Investment Partners, and that's available on our website. We've also discussed how we've tilted to overweight cash holdings in the credit fund since March. Next, how shortfalls on loans are apportioned to investors. Really good question there, Jason. From time to time, a peer-to-peer loan will result in a shortfall. That shortfall is shared in proportion to the amount invested. So none of our portfolio accounts has ever passed on a shortfall to investors, but the same principle applies there. Obviously, this highlights the benefits of diversification for investors. We've got some questions about the loans in the portfolio. So our fund has classically written the majority of its loans on interest-only terms. That facilitates shorter-term loans, which better matches with the investment terms, the term on which our investors are investing. So it gives a stronger liquidity matching profile. We're happy, however, to continue to hold a proportion of the fund in longer-term principal and interest loans. They act as really good ballast for the portfolio. Overwhelmingly, our loans are in metropolitan locations, 92% of the 12-month term account per the asset quality dashboard we discussed earlier. We had very little exposure to bushfire-affected regions, for example. And a question about lenders' mortgage insurance too. So a series of questions from Jason. LMI generally applies to loans with a loan-to-value ratio higher than 80%. So our maximum LVR is just 75%. So LMI is not relevant to our portfolio. Michelle and David are asking how the Reserve Bank's official cash rate movements affect credit fund distribution rates. And the short answer is that the credit fund portfolio income is generated from borrower repayments. So it's changes in borrower interest rates rather than the official cash rate that affects credit fund distribution rates. Now, borrower rates can be affected by movements in the official cash rate. Of course, the two tend to move together, but there's not a sort of a direct correlation, a one-to-one link between our distribution rates and movements by the Reserve Bank. So subtle distinction necessary there, perhaps. Thanks, Michelle and David. Gary's asking whether our credit fund is guaranteed. So no, the answer is no, it's not. La Trobe Financial's not a bank. We're not regulated by APRA. Our offerings are not guaranteed. Further, we've got no intentional plans to become a bank. Now, banks are subject to the federal government's bank deposit guarantee scheme, of course, and deposit rates are unsurprisingly extremely low. In fact, they're lower than the inflation rate. And that, of course, means that investors are actually losing capital value by leaving money in the bank. Our approach is fundamentally different. We're an investment fund. Our objective is to deliver consistent monthly income and to prioritize investor capital. So that's, as we've said before, none of our portfolios, classic 90-day, 12-month, 4-year, none of them has ever lost a cent of capital. Likewise, we've never lost a cent of capital for any of our institutional investors. That's a track record we're very proud of and one that we are entirely focused on retaining. Dana asks about the potential longer-term damage to consumer confidence. Okay, so from the Victorian infection spike. And yes, Dana, look, we agree that a hit to confidence is a risk, but the extent of the economic damage really depends primarily on how competently our authorities can get the coronavirus spike under control. I agree this is a big if, but if we see some success there, if the authorities can reflatten the curve, if we go back to that language, that would be very prospective for medium-term confidence, I think. And without being unrealistic about this, I think everyone wants to see some signs that we're getting better at this whole process. If we start to see those signs, that would be a significant tailwind for growth. Who asks about employment numbers and the outlook for the next few months? Look, we'll learn more on Thursday with the ABS monthly labour force release coming out. Consensus is that employment in June will be up in the order of 150 to 200,000, but an increase in the participation rate. We'll see the unemployment rate lift again to just above 7.5%. Now, as you saw from our table of projections earlier, we wouldn't be surprised if unemployment runs a little higher than that at this time. But look, honestly, the data and definitions are moving very quickly at the moment. So now is not an easy time for economic forecasters. It does seem, as I noted earlier, that our federal government is committing to further support packages for industries most affected by the hibernation. So that's going to cushion the economy, at least temporarily, from the worst effects of the coronavirus hibernation. The primary issue here, of course, is the borrowers in our portfolio when it is for us, and the borrowers that this increase in unemployment pushes into hardship. As we've discussed today, we're seeing some really strong outcomes there. So that's a real positive for portfolio performance. Just looking at a few questions. I think we are talking about the 2 to 3% expected losses. How much will that impact returns? So that's a question from Andrew. Good question, Andrew. So when I'm talking about 2 to 3 percentage points, I'm not talking about 2 to 3 percentage points of losses. I'm talking about 2 to 3 percentage points of loans moving into workout, which means that they'll be working with our collections team. Those will be the loans where the borrower's circumstances have changed and they are no longer able to meet their obligations under the loan on, if you like, a semi-permanent basis. So our collections team will be working with those borrowers to realise the security property. That is, take possession, sell the property and recoup capital, interest and fees owing. So it doesn't flow through, a collections loan doesn't necessarily flow through to losses. At the moment, Andrew, based on all the trends and data that we are seeing, we're not expecting a material uptick in losses in the portfolio. We have plenty of buffers in place in terms of the low loan to value ratio, the investor reserve, and so on. I'm now looking at questions from, I've got a question from an anonymous attendee. What's your exposure to apartments and outlook on apartments market? Well, let's talk about our exposures first. Our exposures, I don't have the number on me, I apologise, but they are typically below 5%. We're not a big apartment lender. Our outlook on the apartment markets, well, we consistently see over many cycles that the apartment market is still in Australia a more volatile part of the market. That is to say, in a difficult property market, we are more likely to see ups and downs in the property market than we are from other parts of the industry. So our outlook, I guess, is a little bit more bearish when it comes to property prices, and that's an observation that should be made too. When we're talking about an 8 to 12% national correction as being sort of our base case expectation for the forward period, it's worth noting that that doesn't mean that loss in value will apply equally across the market. There are many different geographies. If you think of Perth, for example, well, they've had a really flat property market in Perth and a negative property market for many, many years. As a consequence, it's quite likely that Perth may be at or below the bottom and might actually outperform over the next 12, 18, 24 months. So the distribution of losses will differ by geography, but also by sector. A consistent theme we're seeing at the moment, for example, which is very consistent with observations in previous such events, is that high value properties see more value decline than other properties in the market. Now, look, I apologise. I do see that there are some more questions on screen, but that's all the time we have today. We will come back to you on those other questions on an individual basis. So I do apologise. I couldn't get to them in this time. But thank you once again for your attendance and interest in our credit fund. It's our pleasure to be able to assist you with your investments. And on that basis, I'll now pass back to Bridget to wrap up this session.
Thank you, Chris, and to Corey Bannister and to all of our attendees. Thank you once again for joining us today and for your continued interest in La Trobe Financial. Please stay safe and well, and we look forward to your company at our next monthly investor update in August. If you have any questions we didn't cover today, please contact our investment team on 1-800-818-818. On behalf of all of us at La Trobe Financial, we wish you a great month ahead. Thanks for joining us.